October 24th, 1929. The most powerful men in America are making phone calls they will never admit to. The market is collapsing. Fortunes built over decades are vanishing. Not in years, not in months, in hours. But here's what nobody tells you. Some of them knew, and a handful of them, the right handful, walked away rich.
Sell at dawn.
This is not a story about a crash. This is a story about a controlled demolition, and the men who held the detonator. To understand what happened, you need to understand what came before it. The 1920s were a fever dream. America had just won a world war. Industry was booming. The automobile had changed everything. And for the first time in history, ordinary Americans, shopkeepers, teachers, factory workers, were buying stocks. Not because they understood the market, because their neighbor was getting rich. By 1929, roughly 1 in 4 American families had money in the stock market. Most of them were buying on margin, meaning they were borrowing money to buy stocks, betting the price would go up before they had to pay it back. It was a casino, and the house had no rules. Wall Street banks were packaging bad investments, slapping them with good ratings, and selling them to anyone who would buy. Sound familiar? It should. They've done it again since. At the center of all of this were 5 names. J.P. Morgan Jr., Charles Mitchell of National City Bank, Albert Wiggin of Chase National Bank, Richard Whitney, and a man most people have never heard of, Paul Warburg. These weren't just bankers. They were the architecture of the American financial system. They had helped design the Federal Reserve just 16 years earlier, a private meeting held in secret on an island off the coast of Georgia. But that's a story for another video. What matters today is this. By the summer of 1929, some of these men had begun quietly moving their money. Albert Wiggin, the chairman of Chase National Bank, had been short-selling his own bank's stock, which means he had placed a financial bet that his own bank's shares would fall. He stood to profit from the collapse of the institution he ran. He made $4 million in the crash. $4 million. In 1929. He was never charged with a crime.
Where did the depositors' money go?
October 24th, 1929. Black Thursday. Trading opens at the New York Stock Exchange, and within the first hour, panic sets in. Stocks are dropping so fast the ticker tape can't keep up. By mid-morning, the floor is chaos. Men are screaming. Orders can't be filled. The system is choking on itself. And then, something strange happens. At noon, 6 of the most powerful bankers in New York walk into 23 Wall Street, the offices of J.P. Morgan. The meeting lasts less than 20 minutes. They emerge with a plan. Richard Whitney, vice president of the NYSE, walks onto the trading floor and begins placing enormous buy orders, visibly, loudly, for all to see. And it works. The market stabilizes. Prices recover slightly. The newspapers call it a miracle of confidence. Bankers saving America. The system working as designed. But here's the question nobody asked at the time. How did they have that cash ready? How did 6 men, in 20 minutes, produce enough coordinated buying power to stop a market panic? Unless they already knew the panic was coming. The intervention bought 5 days. On October 29th, Black Tuesday, the bottom fell out completely. 16 million shares traded in a single day, a number so large the ticker tape ran hours behind. Men were selling stocks they didn't even know the price of because they couldn't get a quote in time. $14 billion in wealth evaporated in one session. That's roughly $250 billion in today's money. Gone. In a day. Banks called in their margin loans. People who had borrowed to buy stocks suddenly owed money they didn't have. They couldn't pay. So the banks seized their assets, their homes, their savings, their businesses. The banks, meanwhile, the same banks that had sold those margin loans, some of them collected. And then, as the economy entered full depression and millions lined up at soup kitchens, the Senate decided to hold hearings. In 1932, a Sicilian-born prosecutor named Ferdinand Pecora was appointed to investigate Wall Street. What he found was staggering. J.P. Morgan Jr. had paid zero income tax in 1931 and 1932, the worst years of the Depression, through a network of so-called preferred lists, private stock deals available only to senators, judges, and influential allies. It was not illegal. It was designed not to be. Charles Mitchell, head of National City Bank, had essentially invented the concept of selling fraudulent securities to retail investors, products his own analysts privately called garbage. Albert Wiggin's short selling of his own bank was exposed in detail. The country was outraged. Congress passed the Glass-Steagall Act, separating commercial and investment banking. The SEC was created. New rules were written. And then, slowly, over the next 6 decades, one lobbying check at a time, almost all of it was undone. Glass-Steagall was repealed in 1999. 18 months later, the dot-com bubble burst. 7 years after that, 2008. Here's what the history books leave out. The crash of 1929 didn't happen to Wall Street. It happened from it. The same institutions that sold the dream sold the collapse. The same men who engineered the boom were positioned for the bust. And the same system that failed 30 million Americans was rebuilt with their tax dollars and handed back to the people who broke it. Some things don't change. The names change. The instruments change. The terminology gets more complex so that fewer people can follow it. But the architecture? The architecture is identical. The vault gets richer. And somewhere, always somewhere, something else is burning. If you want to understand how it happened again in 2008, and why the same banks are bigger now than they were then, that's the next video. Subscribe to Vault and Ruin. We go where the money went.